The street remains jittery with the Nifty now near the sessions low below the 24K mark. Banks and mid-cap slipped while small caps report outperformance. The volatility index remains elevated as sectors see mixed trends. Banks and autos lag while metals and pharma lend support. Oil prices are under pressure after reports that the IEA is considering its largest ever strategic reserve release to calm markets. The White House says the spike in fuel prices is temporary and could ease once the conflict stabilizes. Leadership change at Indigo as CEO Peter Elber steps down with immediate effect, citing personal reasons. Co-founder Rahul Bhatia will take interim charge. Remember, the move comes after the airline faced massive operational disruptions and passenger backlash. Water infra stocks are in focus after the Jal Jeevan mission was extended till December 2028 with a revised outlay of 8.69 lakh crore. Companies like Viet Tech, Shakti Pumps and Jash Engineering are on fire. The LPG shortage is deepening as the West Asia conflict disrupts fuel supply chains, forcing restaurants across several cities to scale down operations. Industry bodies warn many eateries may shut if supplies don't resume. Meanwhile, Reliance Industries says it will ramp up LPG production. Well, it's a very tough day for streets. In fact, when you're looking at the Nifty 50 index is down 1.3% and from the session's highs of approximately 24,300, we've slipped substantially. We're currently staring at 23,900, at least at this point, as the next support. Of course, we'll get a perspective of what's playing out, but essentially there's plenty of pressure on the Nifty. The Nifty IT, which was doing okay this morning, has slipped quite substantially. You see that slip and we're now down 0.9% on the Nifty IT index, sessions lows. The Nifty Bank though is the real belter because that one has been weak all morning and that weakness has sustained and in fact accentuated. 1.7% lower on the Nifty Banking Index, 56K breached and sustaining. That's really the story of this afternoon. When you're looking overall at some of the big losers, Bajaj Finance, Axis, Bajaj Finserv, M&M, Eicher Motors, all are down over 3% each. In fact, we've got at least 15 to 20 stocks which are down over 1% in trade, from an Apollo Hospitals to a TCS to a Kotak Mahindra Bank to an HUL. All of them facing plenty of pressure. When you're looking at the Nifty 50 gainers, there are just 12 gainers to 38 losers. Jio Finance is the top gainer along with Coal India, NTPC, Sun Pharma, as well as a DRL. Those are just some of your gainers this afternoon. Wipro is the other one. When you're looking at the Nifty mid-cap index, it's down 0.7%. The Nifty small cap index is in the green, but just by the skin of its teeth. It's very, very thin gains for the Nifty small cap index. And we've cooled off substantially from the day's highs. Very curious to know as to what Kunal feels about everything that's playing out. But before I get there, let me quickly also mark out sectors. Pretty much all the sectors trading in the red except pharma, oil and gas, and energy. Those are the three sectors trading in the green actually. Along with it, maybe metals. But again, very, very mild gains for metals. Absolutely flat on the Nifty metal index as we speak. Auto is the big calamity, nearly 3% lower. The Fin Nifty down nearly 2%. The Bank Nifty down nearly 1.6%. And then you've got PSU Banks, which is down 1.3%. The Defense Index also down by a similar number. The FMCG Index down 1%. And the IT Index down 0.8%. So that's really the tilt. It's looking like a very, very tough day of trade. In terms of advanced decline, which was solid, at least to start the day off, we're now seeing a slightly different picture. 1:1 on the advanced decline. It was 3:1. Advances outstripping declines by 3x. Now it's just about 1:1. So we've seen a huge taper and a huge change from the start of the day. I will bring in Kunal Bothra, of course, but Karan here with all of the stocks that are buzzing on the back of various corporate announcements that have come through. Karan, what are those big buzzers?
Well, absolutely. Starting off with the companies engaged in the rural water supply infrastructure, as the relevant stocks are up in today's trade. This is on the back of Cabinet approving the extension of the Jal Jeevan Mission 2.0 until December 2028. This entails a total outlay of 8.7 lakh crores. Now, under the revised framework, the centre's financial support will increase by 71% as compared to the erstwhile Jal Jeevan Mission 1.0. This is set to create significant project opportunities for EPC players, particularly in the rural water supply projects. Key players include VA Tech, KSB, Josh Engineering, and Shakti Pumps, with a strong order book which stands north of 2,100 crores. Followed by Edge Infra, the company has won an order worth 400 crores. The project involves execution of civil works and railway infrastructure for a thermal project in Madhya Pradesh. With this, the order book of the company stands around 13,000 to 14,000 crores, providing a significant long-term revenue visibility for the company. Next, we have Happiest Minds. The company has raised its FY27 growth outlook to 12.5% from 10% earlier. And finally, we have Aditya Birla Real Estate. The stock is up in today's trade as HDFC Securities has initiated coverage with a buy rating and a target price of 1,832, and that's an upside potential of 50% from the current market price. The brokerage believes that the company's geographical diversification is supporting the growth strategy, and the ITC divestment is expected to strengthen the company's balance sheet position.
Hey, Karan, thank you so much for bringing us that. Now, on to the much awaited view. Kunal, what are you viewing in terms of markets? How should one see it? It's looking like a difficult market to kind of predict, because you sounded positive this morning. It's clearly not worked out.
It's not a bad day for the markets, frankly, Harsh.
Okay.
Because it's not as if that, you have all sectors negative like what we had 2 days back.
Yeah.
Even on a day like this, a high beta sector like the Nifty Metal Index is positive. Small cap is trading in, just about flattish. You're looking at the Nifty Pharma Index holding up pretty well. The market breadth is almost even, Stevens, 1:1. So it's not as if that the entire market is going through a sulk and you're looking at a correction of sorts. I think this is more specific towards those odd large cap names which have been weighing very heavy for the markets. And if you try and look at the contribution plate also, I think the picture gets a lot more clearer. You look at HDFC Bank, Axis Bank, ICICI. I think these stocks, like the 4 or 5 top private sector banking names, they are contributing almost 140, 150 plus points as a downside on the index. So I think that's one of the reasons why you're seeing such a kind of an underperformance on the benchmark indices. But as I said, it doesn't look like that it's just spreading to the entire market like what it had a couple of days back. And it's not a signal of a panic, at least emerging as of now. But the only concern is that we've broken below the 24,000 mark. It's a crucial support for the index. We had finally managed to just about recover from those sub 24,000 mark a couple of days back. With this move, the market looks a little bit more fragile back again because of the selling which has not been stopping up. Now, just to try and compare this, 2 days back, the Brent crude was at $118, $120. We are at a point when the Brent crude is almost sub 90. Now, even after a $30 kind of a drop on the Brent crude, if the index are still at the same levels, then I think it's a concern for the market structure overall.
Okay. And you spoke about private sector banks, Kunal. Concerns there?
Yeah, that's the biggest pocket of a concern, Harsh, because with this kind of a selling spree across the large cap names, it's more like traders just wait for a couple of days of an odd bounce into these large caps, stocks to initiate maybe a fresh shot into these names. That's the biggest concern. The other part is I was highlighting this in the morning also that there was a 17.5 lakhs of jump in the open interest on the Nifty on the day where we had seen the index falling by 300, 400 points a couple of days back. Now, yesterday when we saw the markets moving up higher, there was a very marginal unwinding, just 84,000 odd futures which were unwound. So today's data could be a lot more crucial. Why? Because if in case there is more addition of open interest, that would clearly hint that the markets are going with extreme amount of short positions and a clear tilt that the index trend is on the downside. But if we start to see an unwinding on the open interest front, that would probably seal the floor for the index over the near term. So I think today's data could be a lot more crucial to try and decipher that.
Okay. Kunal, your picks in a market like this, you clearly seem, if I can term it, constructive. And And while markets don't particularly look good, you continue to seem positive. So I'm sure there are a couple of buy calls out there.
Yes, Harsh. In fact, so that's what I said. That except for those large cap odd names, the rest of the market is doing fairly well for itself. And there are new sectors and stocks which are emerging in terms of potential candidate of breakouts. We've been discussing about pharma names over the last couple of days. But then the differentiated stocks which are picked at current levels, one would be from the sugar pack, Balrampur Chini. That's a stock which has been holding up very well for itself, trading now about that 500 mark, recovered quite well over the last 1.5 odd month, making a pattern of higher highs and higher lows. So looks attractive at the current juncture, and expecting that the stock would probably try and just about continue its upward movement over the near term as well. Buy with a target of 550, stop loss to be kept at 505. The second would be a buy on Oracle Finance. That's an interesting chart which is shaping up. Interestingly, the stock is forming an inverted head and shoulder pattern. The breakout of this head and shoulder pattern for Oracle Finance is just around that 6,870-75 mark. So my assumption is that if the stock closes above this level, it could confirm a near-term up move for Oracle Finance in the near term. So buy with a target of 7,000, stop loss at 6,730.
Okay, with both of those, Balrampur and Oracle on Kunal's buy list, what we'll do is slip in a very short break. We'll continue conversation on the other side. Stay with us. Welcome back, and we have Ravinder joining us at this point to tell us about the second set of stocks which are buzzing in trade. Of course, we got the first set from Karan. Ravinder, what do you have on your list?
Well, as a whole host of AC and AC component stocks like Voltas, Blue Star and PG Electroplast is buzzing, as a large part of India is experiencing an early surge in the temperature, signaling the onset of summers-like condition in early March, and several regions has already recorded temperatures significantly above seasonal average, raising concern for the warmer products. And early summer means more demand for the cooling product from Blue Star, Voltas, etc. And Blue Star has yesterday unveiled a comprehensive new range of unitary cooling product to drive the next phase of growth. So back of this, all AC and AC component stocks are buzzing. Moving to next, Jindal Steel is also in buzzing, where Jindal Steel has declared preferred bidder for one of the iron ore block in Odisha, and the iron ore block was a part of the recent auction round of a 12 virgin minerals block notified by the Odisha Director of Mines and Geology in December 2025, and the virgin block is G3 level explored with around 50 million tons of iron ore resources as per the government document. So back of this, these stocks is also in focus. Moving to next, Sona BLW is also in focus, whether on the back of the positive brokerage note, where BofA has come out with a note and they have upgraded the stock to buy from neutral and hike target price to rupees 640 as compared to earlier target price rupees 600. They say the company is set to deliver approximately 20% revenue CAGR and approximately 23% EPS CAGR over the next 2 years, and the growth is likely to return after a tough year of FY25 and 26. They say that there will be three growth drivers for the company. First is traction motor, driveline business and railway segment. So back of this stock was up approximately 5% on an intraday basis, but from there it has slightly corrected but still trading in green. And lastly, Jio Financial is also in focus on the back of positive note from the brokerage, where Motilal Oswal has initiated coverage with buy rating and target price rupees 320. They say that the company represents a long-term platform opportunities in India's evolving financial services landscape, which is supported by a strong parentage, a robust balance sheet and access to large digital and consumer ecosystem, and they model a consolidated PAT CAGR of 48% over FY26 to 28. So back of this positive note, Jio Financial Services is also in focus.
Okay, Ravinder, thank you so much for that. Those are some of the stocks at this hour that you want to keep on your radar. Of course, Jio Finance with that, or rather Motilal Oswal with that initiating coverage note on Jio Finance. But Deepan Mehta joining us, Director Elixir Equities this afternoon, with regard to how he's viewing markets. Deepan, let me first set the context. What are you doing at this point? You know, we're in a bit of a between a rock and a hard place, right? I mean, markets are going up one day, down the next. Are you using this volatility to buy? And would you say that a large part of the dip is already priced in now and not too much to go from here?
Hi, good afternoon, and thank you for having me on your show. You asked what I'm doing just now. I'm just staying put.
Okay.
I don't think it's the time to buy. The time to sell certainly is gone, and it happens so suddenly. So there's no question. And the real problem here is that there's not enough cash in the portfolio. I mean, if this is going to be a long drawn war and it's going to spread and we're going to have elevated oil prices, and if it's going to get worse, then you would prefer to have more cash in the portfolio. Yet again, at the same time, if it gets over quickly, then also I think we are more or less fully invested. So we ride the upside. So right now, it's just kind of wait and watch. But yes, I think this correction is a great opportunity to improve the quality of the portfolio. So certain laggards in the portfolio which have not done well, results have not come good. They also have corrected, release the cash over there, and increase the cash levels in the portfolio, or B, then look for good quality stocks, especially large cap stocks, because I think whenever the recovery takes place, large cap stocks will be first off the block. Companies who missed out on earlier to buy, like say a Larsen and Toubro or a Bharti Airtel, something like that. We know they are steady compounders, and that eventually when markets go back to normal, these companies can easily deliver 15-20% type of a return. You could add some auto companies to it also, the likes of say M&M or Eicher Motors for that matter. So that's what the kind of thinking is just now, not to be too kind of smart and try and buy small mid cap stock, although there's good value over there as well. But it's better to have the right proportion of large versus small, great quality businesses versus opportunistic investments.
Oh, there's just so much to unpack in what you just said, Deepan. And let me try and do that actually. So you're suggesting you sell some of your plays which haven't done much, or your weaker hands, as one would call it. But some of the weaker hands have really fallen, Deepan. So if the market's fallen 10, some of those have fallen 20, 25. What do you do then? I mean, do you still maybe sell something 25% lower and buy something which is 10, 15% lower, say an HDFC Bank, for example?
Yeah, I think tough call to make. It requires certain amount of courage, but that will work out better for you, because those mistakes which are there, uh, what will you sell in your portfolio right now? You see, if you want to improve the quality of the portfolio and take advantage of this correction and buy great stories, great stocks, especially long-term ones, how will you release the cash? So you can't sell off the winning performances, the stocks which are doing still very well. So you have to sell your mistakes, sell the stocks which have not delivered, where the investment rationale no longer holds water, and deploy that cash elsewhere. I mean, I know that every time it will not turn out to be right, but I think that just makes sense to me intuitively as well. To go for trying to improve the quality of the portfolio. And the only way to do that is to sell the laggards, sell the losers, sell the mistakes, and use that cash to buy into stocks where now there's margin of safety. Stocks you've always wanted to buy but couldn't buy because they were too expensive. So this is the time to do that, I think, rather than when the market is on the go. And this whole process can be done very in a slow manner, very well calibrated and spread over a period of time. It doesn't have to be like, at one shot. You could look for minor upsides to sell off and then wait for corrections to buy as well. So something like that, investors can certainly try and adopt.
Okay. Deepan, I'm going to take a pause on this conversation with you. Switch over to Kunal and trying to kind of gauge as to if there are downside risks, Kunal, at this point with regard to the market. Where are the support levels? Because multiple people saying multiple things. I'm trying to understand your view of the support level. Say, would 23,800 be a good support? And thereafter, where is the support? Give us 2-3 support levels from here.
Yeah, so the most immediate support for the index is from where we bounced off in a couple of days back. That's on Monday. So that level is around 23,700 for the index. We made we made that low on the Nifty spot. I think we made a low of precisely 23,697. So which means approximately 23,700 is a good support for the index in the near term. But then I was actually looking at the strikes, where there has been good amount of open interest built up. So what's happened is today at the 24,000 strike, there has been a big jump of fresh shorters or call writers at those levels, and then to offset that, the next best strike on the downside is 23,500. So which means that the two support levels which one should be looking out for is 23,700, which also coincides with the last 2 days of a swing low. But then below that, very high probability that if we scale below that 23,700 mark, we should be looking at 23,500 as the next target or the next support for the Nifty.
Okay, so that's the take with regard to support. Deepan, very quickly, if one were to make the tilt, you threw a couple of names at us. You threw L&T, for example. You threw M&M, for example. Give us a few names, mid, small cap, because that's where the pain is more pronounced, which would be really good buys at this point if one were to be tilting their portfolio or, happen to be sitting on cash. What should one be buying?
So I think just taking the basic investment theme forward. So within the large cap, you could even add Indigo to it. It's a bit of a controversial name, but if you're patient and have a 2-3 year type of a view, then this is still available at very attractive valuations, in my opinion. In blue sky scenario, this company can make about 12,000 crores of PAT, and its market cap is about 1,70,000 crores. So I'm comfortable with the valuations and the potential of this company. Secondly, I think within the large cap, I give you the auto names, and also I suggested Larsen and Toubro. So within the same theme of Larsen and Toubro, there is SEM India, there's VA Tech Babag, which is also doing very well. I know that VA Tech Babag also has exposure to Middle East, but look, you have to see beyond present crisis, and when things kind of settle down, there'll be even more work flowing from the Middle East for these companies, and these companies have been kind of well entrenched over there, and they are kind of ready to take on business. They're already empaneled with the big customers over there. Then I still like the travel and tourism space. So some companies like that over there which come to mind are companies like BLS International, which does visa processing. We also like Yatra Online, which is an online travel portal. Great set of numbers for the September quarter, but you need to account for 2-3 soft quarters, December, March. Great set of December quarter numbers, but you need to account for soft quarters. March, June would be quite brutal. But then these companies intrinsically, I think they're great business models, in my opinion. Then we like the kind of companies supporting insurance, healthcare space in the US. Companies like Inventurus, Sagility, they do billing in US dollars, so some benefit is coming from their depreciation over there as well. And the entire kind of trend towards using healthcare costs in US benefit these companies with great scope for outsourcing. Within India, there's an insurance claim processing company called MediAssist. They have been doing interesting acquisitions and now are the largest third-party provider of claim processing. And that's a business which is going to be flourishing as and when insurance starts to, grow. So it's like a periphery business which will really benefit from there. So like that, I think there are many such stocks, and we go by investment theme or sector and look for businesses which have got a slightly different type of outlook or model, and it should be scalable as well.
Thank you so much, Deepan, for joining us, giving us that perspective on a day like this. That's, of course, Deepan Mehta with his views. But what we'll do is slip into a very short break. On the other side, we'll have Rajendra Gandhi, Managing Director at Stovecraft, joining us to give us a sense of what this could mean for his business if maybe things were to continue as is for the next maybe quarter or two. We'll try and get that perspective on the other side of this break. Stay with us.
Crack in the market. We're headed in for a 350-point decline in the Nifty futures alone, just about on the brink of that 24,000 mark on the futures, in fact. And the spot Nifty, of course, is much lower at that 23,900 thereabouts level. Look at what's happening within financials. Bajaj Finance is now down a solid 4%. You've got Axis Bank, which is headed in for a 4% decline. There's, of course, HDFC Bank, which is now headed in for a 2% decline. Shriram, which was one of the top movers on the index, that's down 2%. And autos, quite interestingly, the days that the market cracks, it's actually autos, which is also at the bottom of the pack. It's no different today. You've got M&M, which is down over 3%, Eicher, which is down over 3%, Bajaj Auto is down 2.7%, and Maruti as well, lower by about 2.7% as we speak, along with, of course, Tata Motors PV, which is also facing the heat. Other than that, some of the select metal counters like a JSW Steel is down over 2%. You've got a Tata Consumer, Trent, Titan, Bharti is down about 2% as we speak right now. And some of the IT names as well are languishing a bit. TCS is down. And then, of course, there are other names like BEL, which is also weighing heavy right now in the markets, down about 1.7% as we speak right now. And once again, it's the PSEs which are actually holding out as we speak. Look at a Coal India, NTPC, ONGC. They are the ones which are staying afloat. Other than that, a couple of these pharma names as well. But yes, the LPG crisis, and that's clearly brewing now closer home as well. Its impact is now spilling into the streets, and restaurants are scaling down operations as supply disruptions continue, with many businesses warning that operations may not sustain for long. In fact, my colleague Anurag Shah brings us a ground report from Mumbai's Pancham Puriwala. Let's take a look.
Currently, I am at 175-year-old famous legendary eatery restaurant in Mumbai, and there is a poster outside, no gas supply, sorry, not all menu items available, written in Marathi also. So yes, this is famous legendary eatery shop, the famous restaurant, 175-year-old Pancham Puriwala. So the menu options in Pancham Puriwala restaurant is reduced by 70 to 80%. So previously, the Pancham Thali used to have 10 to 12 items, but now you can see only 3 items are available due to less supply of LPG, commercial gas. Whole menu is not there. The menu is reduced by 80%. And now I'm joined by the owner of Pancham Puriwala, Anupam ji. Sir, we can see this poster, and your menu is reduced by 80%?
Yes, sir. We had to reduce. हम लोग के पास option ही नहीं था. We didn't have any option. Okay. We had to reduce because we wanted to survive for more longer time. Less usage of LPG so that we can survive for 3-4 more days.
3-4 more days. So from how many days this less supply is there, and since when you have reduced your menu option?
Menu options we were forced to reduce since yesterday, but there's no supply since last 5 days. This is the 6th day. We have not got a single cylinder also.
Well, things hitting hard, and these are eateries that all of us have visited here in Bombay as well. And clearly the LPG crisis is definitely now impacting normalcy as well. But look at, the market as well, because I just want to see whether or not this is a global phenomena or is it just an India market standalone kind of problem. Because even Hong Kong, while it started off the day in the green, finally closed in mildly soft. Shanghai was off the day's highs, though Japan managed to hold ground. What about the European markets? They have actually started off sharply lower, because across the street, you are seeing cuts of about 1 to 1.5% apiece as we speak right now. The pre-market rates for the futures as well are languishing just that tad bit. And once again, you are seeing oil prices spiral up. We're holding at 4.25% of an uptick. 87.01 is where you've got Brent currently trailing at. And that impact clearly being felt by equity markets as we speak. But Kunal, particularly on private banks, I mean, look at an Axis, HDFC Bank, ICICI Bank, all significantly under pressure. And this is not just today. It's been the case for what, almost a month now?
Yeah, I think it's been more than that, these banking stocks have underperformed. Very difficult to find the reason for that, because it's just specific towards these banking names that there is an extreme amount of selling. These stocks have broken far below their long-term moving averages. So just to put this into context, the 200 DMA for HDFC Bank is at 930, 940 levels, and the stock is 100 points almost lower than that kind of a 200-day moving average. So it's not as if that the stock has gone through a very recent sell-off or a correction or a mean reversion. all of those are behind for the stock prices, and this is some serious selling which is going on into these larger cap names. In this kind of a scenario also, I think it becomes very difficult to anticipate when would these stocks start to show signs of bottoming out. We were discussing this couple of days back that if in case these stocks bounce back, should one try and take opportunity off? And I strongly believe that you should try and buy these stocks once you see a strong confirmation of an uptrend rather than any kind of a bounce back. So the immediate level on the upside, for example, for HDFC Bank lies closer to 900, 920 mark. So I think it's better to try and wait for that those levels to be broken out for these stocks to try and confirm a reversal of the trends. Otherwise, I think with the pace of selling which has been going on to these names, there is a probability that these stocks can crack a little bit more further.
Okay, pretty precarious right now for private banks for sure. And of course, amidst that, there's also autos and a lot of these consumption, even the IT names and SBI as well, which has also fallen another 1.5% as we speak. We'll take a very quick break, come right back. We'll continue tracking markets. Back with closing trades right here, Leety. Now let's just revisit what the closing trades are looking like, because we're now headed in for a 400-point decline. And even on the Nifty futures, we've breached that 24,000 print. Like I said, it was autos, couple of the financial heavyweights. Axis is now down 4%, Bajaj Finance down 4.5%, Bajaj Finserv down 3.5%. And then, of course, there are those large cap heavyweight auto names. M&M down 3.6%, Eicher down 3.4%. You've got a Maruti, which is now down 3%, Bajaj Auto, which is headed for a 3% decline, Shriram down 2.5%, Tata Motors PV down 2.5%. And the entire consumption class, irrespective of the sector. Look at Titan, it's down 2.5%. Asian Paints fallen quite a fair bit, 2.25% of a cut coming in there. Trent is languishing, just about skirting around that 36.50 mark on the futures. And Tata Consumers, etc. as well are facing the heat. Bharti down 2% right now. BEL is headed in for a 2% cut. And TCS and Reliance as well are down 1.5% to 2% apiece. But also the cabinet has approved extension of the Jal Jeevan mission up to December 2028 with enhanced outlay and restructured implementation. The focus this time around will be around structural reforms in rural drinking water supply. My colleague Karan joins in with more details on what exactly does this announcement mean for India Inc.
Well, the cabinet has approved extension of the Jal Jeevan mission up to December 2028. Remember, the purpose of the Jal Jeevan mission was to provide functional tap connections to every rural household in India. The cabinet has approved enhancement of a total outlay of 8.7 lakh crores. At present, out of 19 crore rural households, around 81% of the households are reported to have tap water connections till date. The Jal Jeevan Mission 2.0 is the next phase, which is focused towards distribution networks and last mile connectivity inside the villages. Under the revised framework, centers' financial support will increase by 71% as compared to the erstwhile JJM 1.0. The government's Universal Tap Water Connectivity Initiative ensures a multi-year capex program for India's rural water infrastructure. The extension of the JJM program is expected to create significant opportunities for EPC players, specifically in the rural water infrastructure segment. Taking a quick look at some of the players in this segment, VA Tech, a leader in water technology specializing in EPC and operations and maintenance for water treatment, followed by Enviro Infra Engineers, Jash Engineering, Kalpataru Projects International, which is focused on last mile connectivity for rural water supply grids. Remember, the company's 10% of the order book is inclined towards the water supply segment, so do watch out for that as well. And finally, we have Shakti Pumps, in conjunction with the PM Kusum Yojana, a major player in solar powered pumps for rural water management and irrigation.
Okay, and some of those themes are actually holding out very well. Everything from a Kalpataru projects. You are seeing that bunch of stocks hold out very, very smartly in trade. There you go. Jash Engineering higher by 5%. Enviro Infra, VA Tech Vabag, all looking up as we speak in an otherwise extremely weak market. But yes, there are a handful of movers there as well. DRL, for instance, is holding out well. Glenmark is looking good. You've got a Supreme Industries, which is higher by 2.5%. Coal India has been standing strong. ONGC is, holding up about almost 0.5%. Oil India is up 2.6%. And then Blue Star and Voltas, the entire white goods consumption theme, that's the one which is looking smart, the consumer durables, that is. Kunal, you also like Blue Star, right, amidst the entire durables pack?
Yes, absolutely, and still looks very attractive. So for the last, I think, 3 or 4 weeks, the stock has been trading in a 100-point range. So I think closer to 1880 to 1950, 60 thereabouts has been the trading range. But the indicators have started to turn up for the stock price. It's looking extremely strong at the current juncture. Add to that, names like Voltas as well as Havells. I think these stocks have also started to look a little bit more attractive.
Okay, some important clarification as well from the government that they're going to soon be listing out the sectors with which the FDI rule with the country sharing its land borders actually applies to. And I think that should make the auto industry happy that rare earths as well is part of that relaxed FDI norms list. But we'll take a very quick break on that note. Come right back. We'll continue tracking markets. Back with closing trades right here in ET Now, and we've breached that 24,000 mark for the Nifty futures as well. Just a short while back, 400 points of a decline is what you're seeing. And it's clearly financials and autos which are weighing heavy on the markets. Other than that, of course, automobiles, telecom, FMCG as well are really not supportive. Perhaps there's only pharma and oil and gas which are a smidge in the green or relatively better than what the other sectors have been doing. But let's welcome on board Sunil Subramaniam as well and find out what he recommends doing in this market right now. Sunil, hi, afternoon. Welcome to the show. Sunil, what explains this incessant weakness, especially in the private banking names? I mean, ICICI Bank, HDFC Bank, the list can go on.
It's a combination of 3 factors, all related to FIIs. So the first is that I think there's passive money flowing out of emerging market ETFs and with India-specific ETFs. So the banks being the largest weight in the index, fund managers don't have a choice in passive funds. So I think there's a, 30% drag on that. That's number one. Number two is that the speculative activity, because there's a risk off on India, there's a huge, bank Nifty future, they're shorting. I think that contributes again to the bank's thing. The third aspect is that they're also specifically taking stock futures negative. I know this is all technical, but that's what I've got to understand, that this is the combination. And you have to layer this with the fact that DIs are booking profits when the FIs are, DIs are not buying it because they've already stocked up a lot on the banks over the last 1 year, 1.5 years. I don't think they have an appetite to take on more of the banking which the FIs are selling. So I think this lack of support from DIS and this diverse range, and essentially what we are then talking about is that it's sell India on rise for the FIs, because the India is the biggest single impact of an oil price in the entire greater world, right? We are the ones who are 85% of oil. So the perception, and what happens is that the fact is that there's a lot of algorithmic trading going on. So when you then, for India-specific factors which are fed into a computer to say this triggers a sell off, this triggers a stop buy, stop loss, whatever, oil-related matters are a significant part of that. So any sensitivity to that leads to a sell of India. It's a pack, and I think banks are suffering the load. Finally, of course, is that the strong dollar is not helping. The rupee again today is weakened a little bit. Yesterday it strengthened a little bit. Today again is weakening. So I think that's again makes the short-term trader sell India. And banks, unfortunately, because they're 30-35% of the index, have to bear the brunt of the sell-off.
That indeed is the case. But do you at all, Sunil, recommend buying in this current decline or at least nibbling in, or would you say wait it out?
I think nibbling in is the right approach. I think that I'm saying that if you have free cash flow in your hands, put 1% every day into the markets and I would say buy in proportion of your holdings before the geopolitical crisis started. This particular one started, right? You have built up the portfolio with a certain view. I don't think India's view of that has changed. Yes, short term there'll be impacts on GDP. Short term oil related sectors may get more impacted, but I expect that oil is an extremely V-shaped phenomenon, right? It falls sharply, rises sharply, falls sharply, rises sharply. So, the ECG chart of that would make you immediately have a heart attack. So, as far as that is concerned, I wouldn't get worried about that oil prices are hiking, because when all the dust settles, they'll come back. But I don't want you to then go and take a big bet on oil, because it could go much higher. It touched 116, 17. It's come down to 85, now back to 90 plus. So the volatility is just too much for you to play the field there. My recommendation is that whatever you feel is a medium term portfolio allocation before this whole Iran, Israel, America triumvirate action started, right? I would say the market, when it comes back to its normalcy post this crisis, it'll again build back on what we felt was good for India. So to that extent, I would say don't have to fresh think about it today, but what you had before, start nibbling at it, start buying, and 1% a day will make your free cash flow last 100 days, which is 3 months, which I think is as far as I'm concerned, the outermost that this war will last as an impact. I think the pressure is too much on Mr. Trump with local gas prices, on Israel to bring a conclusion, and on Iran to get back life to some stability. So I see that in a 3 month time frame, the war will get settled one way or the other. So this is a very good way of averaging out your portfolio. And so, just to summarize, I feel you should continue nibbling.
Good strategy there, Sunil. But what sectors would you say that one should start with?
Well, obviously, it depends on your risk appetite. If you are an aggressive person, I would say actually go and buy the oil-related impact, because we know that oil is just sentimental. The Hormuz Strait closure is a huge thing. We can't expect it to continue for too long. This oil-related thing can't continue for too long, right? Like I said, 3 months. So whatever gets hurt by oil is going to bounce back. So if you have the stomach for it, and if you have the stomach for another 10-15% downfall in the prices of whatever you buy, if you have the stomach, keep buying those, because they are the ones going to bounce back the strongest. But like I said, in Hindi, jigar chahiye. But if you're not like that, if you're a moderate, well-diversified investor, then stick to the non-export, non-external related factors. So again, banks for me are a good buy at these prices which are falling, because I don't see that the Indian economy's downfall is going to be so great because of the geopolitics that banks are suddenly going to see huge losses or whatever. All of this is just that it's a good profit booking. Even for an FII, he's made a lot of money from the whatever they had put in PSU banks and banks. So they're booking profits. So I think something which was valued at a particular level before, I don't see why it shouldn't come back. So if you're moderate, I would say hang around the banking, financial services, and the consumption pack. And if you're aggressive, you can actually go and take calls on the oil impacted sectors. So I leave the choice to the risk appetite of the investor.
Makes sense. Well, Brent
Nothing
already...
to be done in a 3 month time frame, please. If you have a 3 month outlook, keep quiet. Go watch the movie. Durandar 2 is releasing in a few days.
Have you booked your tickets? Sunil, I'm guessing you must have already booked your tickets, haven't you?
Of course. First day, first show, I will be there.
Same. Well, I guess when you're in the market, that's what you need to get your mind off, right?
Absolutely. This is the best time to de-stress yourself.
Yeah. Okay, 4 hours, enjoy. But Edgy Infra, that's the one stock which is in focus in today's trading session, as the company's bagged orders worth about 401 crore rupees from the MP government. What exactly does it entail? Where does it take their total order book? Rabinda is here with all those details.
Well, it's on the back of order win, HG Infra Engineering is in focus, where company has received a work order from Annapur Thermal Energy MP Private Limited for the execution of civil works railway infrastructure development for 2 into 800 megawatt thermal power project in the Annapur, Madhya Pradesh. And the scope of the work include earthwork, construction of bridge station buildings, and PVA works for railway infrastructure. And the cost of the total cost of the project is 401 crore and is expected to be completed within 18 months. Remember that earlier company has also received a letter of award for worth of rupees 1582 crore from the National Highway Authority of India, and with these two orders secured in Q4 FY26 so far, the company's total order books has increased to 15,607 crore, and according to management, the company expect to secure a 4,000 to 5,000 crore of new order by the end of FY26. Management said this in the earlier con call of Q3 FY26, and with this the two recent order win, the new order inflow have already reached to 5,283 crore, and for FY26 the management has guided for the order inflow of between 10,000 to 12,000 crore. So back of this order wing, stock is in focus, and the stock is up more than 16 to 17%.
Right, that's HG Infra, and the stock, of course, is mighty excited. There are some of the other stories as well. I mean, consumer goods, for instance, we were just talking about with Kunal, they're holding up well. In fact, look at a Blue Star, it's surged up about 3%. You've got a Voltas, etc. as well, which have been looking very good. Symphony is the other one, which has been holding out well, and this is not restricted to today's move. In the last 15 days itself, these are stocks which have been propping up. Sunil, any of those weather-related themes that you would be betting on? Anything from FMCG or, for that matter, white goods?
No. Yes, of course. Like I mentioned, no, consumption is a fact that we should be backing here. And because you see, remember, when all the dust about the thing settles, the consumption sector, barring auto, has not felt the full relief of the GST yet in its numbers or in the market appreciations. So I think consumption is still the story to play. The GST cut is real. There's no sentiment involved in it. And I think that it'll start playing from consumer durables, cooling related durables in the summer through to all the rest of the festive season starting. We'll see the non-auto pack of it really starting to benefit. And I think so domestic growth numbers from there will be pretty strong, right? Just keep in mind that their immediate margins might get affected because of the oil ring. Some of them do have crude related derivatives in the manufacture. So just from a short-term EPS, they might not be up to expectation, but that's okay. The sales numbers, because they're highly operating leverage companies, the top line growth will be easily, much more beneficial from an EPS growth perspective. So yes, for me, bet on the full consumption pack, I would say at this stage.
Interesting. Well, Keynes, that's the one stock which is also in focus after the central government reworked its pandemic-era FDI curbs. We spoke with Ramesh Kunnikana and the executive VC at Keynes, who welcomed this move as it benefits Indian EMS sector. Let's hear out an excerpt from our chat with him.
This is something which we were all looking for a long time. We should welcome Government of India's decision. This will help higher technologies to come into India faster. If we have to start from the beginning, then it takes a long time for us to implement. So that way, this will definitely help us. India as a country, EMS as a sector, because electronics, the high-tech and high impact industry, where a lot of indigenization can be done quickly by having JVs and bringing technology partners from outside. Then margins, it is supply chain efficiencies which will come in. Secondly, what is happening is all these small impact on war and other things in the long term will all vanish if we have local manufacturing. And then local industry will grow with a ecosystem developing all around. So this is something which is really going to help us. Then freight cost, when it comes to the cost, freight cost, and Indian industry has proven in the past that they will bring down the cost. So I'm sure and certain industries will get benefited out of it.
Okay, so that's the take. Kunal, let me come to you with regard to some of these EMS plays. Of course, there's plenty of positivity on some of those counters. Yesterday, there's been a bit of a cool-off from those highs. Any favorites within this pack? And even the one or two stocks that you talk about, give us levels that we should watch out for. At what point should one start buying?
So, the best way to look at it is that the recent low with these stocks had made. So, for example, Dixon Tech made a low of 10,000 thereabouts. Sirma SGS, Keynes, etc. These stocks have risen up by to 15% for Dixon Tech, for example, and then 8 to 10% higher for Keynes and the other names. So the recent swing low becomes the first important support for these stock prices. But more importantly than the price support over here, what matters in these cases, where these stocks are in the process of trying to absorb positive news flow and then come out of a huge downtrend for themselves is we look out for divergences on the indicators. And if the RSIs, they continue to protect the previous swing lows, that's the very strong indicator that these stocks are in the process of forming a bottom. So price-wise, you might see maybe a point where in case if the market sell-off gets a little bit more accelerated, you might see these stocks coming closer to their retest of the previous lows. But the RSIs could be a lot more higher. That, I think, is a very strong indicator that these stocks would probably be in the process of forming a bottom. So price-wise, yes, the previous lows of 10% lower approximately for names like Dixon Tech, etc., could be a good support point over the near term.
Okay, so that's with regard to EMS. Sunil, I wonder how you're playing the entire data center and AI theme, if at all there is any way to play that from an India equity investor standpoint.
Well, I mean, you could have a slightly medium-term outlook. It's ultimately going to be the Indian software companies which are going to execute these data center-related matters, right? They have the domain skill, they have the employee strength. So, but it's in the near term, they are a negative of the AI win, but they will turn positive. But you've got to have patience to do that. Other than that, the only other way to play the data center is a real estate pack, because there's going to be huge demand for corporate real estate. So that's one way to place. It's not directly AI related, but the spin-off benefit of that will come through that. So other than that, I don't think that a lot of these data centers are going to be a listed place in the Indian stock market. So it's just going to be an overall spillover impact there. So for me, like I said, IT with a medium-term approach and real estate.
Right, just monitoring what the US futures have been up to. We are right now 150 points lower for the Dow futures and marginally lower for both the S&P as well as the Nasdaq futures as well. Europe, of course, is cracking quite hard. You're headed in for a 400-point decline for the DAX. The FTSE is down about almost 100 points. The CAC is down about 1%. Stock 600 down 1%, and a 1% decline coming in for the FTSE MIB as well. So that's where you're seeing that pressure. And, you know, we as well are getting leapt in that same vein. Bajaj Finance, that's, of course, been a key drag today, along with Shriram, which are both down about 5%. Even Dixon has cracked about almost 4%. KEI has been, weak off late, another 4% down for this stock too. And then TVS Motors, which has also slid about 4.5%. Colgate, you typically don't see such sharp moves on a name like Colgate. That's down about nearly 7% as well as we speak right now. But again, Kunal, within autos, how much more of a decline do you suspect or foresee? And when is it that you start buying the decline in autos?
Yeah, this is more of jitteriness from the market. You know, it's not that the crude oil prices are back to 120.
Capital protection, basically.
Capital protection, this is more of fear which is there in the markets, which is creeping in, that maybe crude oil prices could spike one more time. Maybe there could be a chance where these auto stocks probably will see maybe a sentiment as well as a price damage for themselves. So I think the markets are trying to prepare for that. Maybe that's one of the reasons why such a kind of a bounce back which we've seen yesterday has been immediately negated for many of these auto stocks and many of these other larger cap names. That's the only reason which I think one could probably attribute. But again, I think these are conjectures, because to try and put this into an established view that the crude oil prices will come back towards 120 mark, that only time will tell, maybe over the next couple of days. But it looks like that the markets have still not found its feet in terms of trying to subside with this volatility. The India VIX was 24 2 days back. We were at 18.5 odd levels yesterday. Today we are back to almost 21 plus mark. So this 3.5 point jump in the India VIX at a range of 20 is not letting the markets settle very, very easily.
Okay, that's the fear factor playing out in the markets. But air travel, that's also set to get costlier. Air India is now introducing a fuel surcharge across domestic and international routes, citing a sharp rise in aviation turbine fuel or ATF prices because of the Iran war. In fact, the airline will now roll out the increase in 3 phases starting March 12th. The concern is that other airlines may also be following suit. Anurag Joshi is here with the ground report.
Air India airfares are set to get costlier from March 12. Air India has announced an expansion of the fuel surcharge on its domestic and international routes. The implementation of the fuel surcharge increase will happen over 3 phases. And for domestic routes, the increase will be 399 rupees, while for international routes, the increase in Air India's fuel surcharge will range from $10 to $50. Air India says that the move is necessitated due to as a fallout of the West Asia conflict and also a rise in the aviation turbine fuel, which the airline says accounts for 40% of any airlines operating costs, the new fuel surcharge increase will also apply to Air India's subsidiary Air India Express flights.
Okay, Sunil, let me come to you with regard to Interglobe Aviation in particular. What's the view there? I mean, we've seen a significant decline from the highs. Give us a sense of where you sit at in terms of a view.
I just spoke about it from the airline perspective. If you're an aggressive risk taker, I think it's worth doing it because both those impacts which are seen on the airline sector, which is the fuel price rise as well as the ban on the air travels, are short-term phenomenon. And Air India, with the launching the surcharge, means that Indigo and other airlines will follow suit. So they are protecting their bottom line. This is not good news from the flyers in the country, but it's good news for the companies, right? So I would say that they are doing well to defend themselves by at least partially doing this. So to me, like I said, it comes from, if you're an aggressive bet taker, then I would say from a medium term, all this correction has been good because this is an extremely panic reaction to a very, very deep geopolitical event, but which won't last forever. So I think that one has to buy expecting the normalcy. The million-dollar question is, when will the normalcy arise? So if you have a time limit in mind, 3 months, 6 months, don't touch it. But if you're in there for the medium term, then these prices are probably very good bargains for you to buy it.
Interesting. Okay, that's the play. Kunal, Interglobe Aviation, if not at 4350, at what level? And if at 4350, what levels do you look for from here?
See, I think this is an event-based move which is happening for Interglobe Aviation, and I think you have to try and, at some point of time, the opportunity will be very, very strong for these stocks to try and come back into a value territory. You know, you've seen almost, I think, 3 negatives playing out for Interglobe Aviation in the last 2 or 3 months, starting from the month of December when the stock was almost at 6,000 levels. Now, from 6,000, the stock has corrected towards 4,000 mark. The knee-jerk impact, which I think the more recent one, is because of the spike in crude oil prices and the expected, price, increase over there. So my sense is that maybe you might see maybe a 100 point or a 150 point or a further cool off into the stock price. But closer to that 4,000, 4,200 range, I think is a very strong range where one could look to buy Interglobe Aviation. It's not that the stock may not fall lower, but there comes a point where the price, the risk reward is starts to be a lot more attractive. I would believe that level could be at 4,000, 4,200 for Indigo.
Okay, that's that on Interglobe Aviation. But Bank of America has upgraded Sona BLW's rating to buy with a target price of 640 now. They're saying growth is likely to return for the company after almost 2 years of underperformance. Rapinder is here with details from that note.
Well, on the back of positive brokerage note, Sona BLW is in focus, where BofA, Bank of America, has come out with a note on Sona BLW, and they have upgraded the stock to buy from neutral rating and high target price to rupees 640 as compared to earlier target price of rupees 600. The brokerage expect the company to deliver approximately 20% revenue CAGR and 23% EPS CAGR over the next 2 years, with growth likely to rebound after a tough period of FY25 to 26. And they say that the key growth drivers include the traction motors business, which is expected to double over the next 2 years, which is supported by the company's technology edge in light rare earth motors and the customer wins. And the driveline business is also expected to return the growth with an approximately 12% revenue CAGR after the witnessing of weak growth over the past 2 years. And in addition, the railway segment is also emerging as a new growth driver for the Sona BLW, and the railway business could contribute to approximately 25% of the total revenue by FY28 compared to earlier estimate of approximately 20%, and may deliver 18 to 20% revenue CAGR in the medium term, which is supported by the strong government capex in railway modernization and high-speed trains. BofA believe that the risk reward is favorable, and after nearly 2 years of the stock underperformance, and they have raised EPS estimate by 2 to 7%, and they say that the upside potential could come back from the market share gains from European suppliers and new opportunity in areas such as humanoids and sensors. So back of this positive note, Sona BLW is in focus.
Okay, thank you for that, Rabinder. Sunil, let me come to you with regard to auto ancillaries. And this has been a very decent play over the last, maybe 4 to 5 months, because it's very closely linked to OEMs. Would you, at this point, play auto anch over the OEMs? Is that how one should position themselves?
See, that's a very tough one because, see, like I said, auto, barring the recent correction, had seen a very strong rally in the back of the GST cut led boom. And auto anchors actually were more dependent on an export-oriented thrust from the EU deal as well as the American deal. Now, the American deal is effectively on pause, and we'll have to wait and see how that pans out. So, from that point of view, I think that I would, at this point of time, have wait and watch on both auto OEMs and auto anchors.
Okay. Kunal, M&M in particular, do you have a view on that one? Because we've seen how the stock has moved all through this week. I'm trying to understand whether there are any fresh bases that have been created and whether there are enough support levels there to kind of trade this one.
See, price-wise, the stock is below 200 DMA. It's below the 50-day moving average, and all of those key price points are of support for itself. But as I was pointing out earlier, that the RSIs for many of these stocks are much higher. I'll give an example. For example, in the month of Jan and Feb start, when M&M was at 3,400 levels, it coincided with the 200 DMA. The RSIs at that point was closer to 34, 35 for M&M. Now the prices are at 3,200 levels thereabout on the spot basis, and the RSIs are at 39.40 for the stock price. So you see that relative strength which is there into these stock prices. This indicates that maybe these stocks are in the process of finding a bottom for themselves. Sometimes it takes weeks, sometimes it takes few days, depends on the kind of market scenario. But I believe that those are opportunities where traders generally try to add or average more quantity, accumulate more further. I think that should be the case for many of these auto stocks, unless you're looking at a point where the current crude oil based scenario and what's impacting India specifically, I think that takes into a different proportion altogether.
Well, 23,858 now on the Nifty. In fact, the breadth of the market has worsened quite a fair bit. 166 point stock standing to the red as we speak, if not more, on last check within the FNO pool itself. So that's a little bit worrisome. 176 stocks now, I stand corrected, and only 35 standing to the green, which are largely Nalco, Premier Engine, Supreme Industries, Blue Star, and of course Oil India has strengthened further, which is now holding up a good 2% as we speak. But Sunil, within the entire PSU pack, and let's exclude banks right now from the list, what is it that you're liking?
On the PSUs, I'm not sure that I like anything in the PSUs.
Okay, fair point. But Kunal, your observation is that it's actually the PSE index which has been doing very well, right? And ex-banks as well. What's a good trade to take for a slightly longer term?
Yeah, so there are a lot many PSU stocks which apparently have been doing very well for themselves. The likes of MCX, BSE, the defense names, Coal India, NTPC, ONGC, etc. When you try and look at these charts over the last 3 months or 6 months, they've been very, very strong. And that's one of the reasons why you've seen that the CPSE index has done very well for itself and it's managed to shield from the overall market trend in the last, I think, couple of months specifically. I would still believe that ONGC, NTPC, Coal India, they are very strong breakouts. We've seen weekly and the monthly charts turning for these stocks in terms of indicators. So unless there is something completely dramatic negative for these stocks in terms of news flow, it's going to be difficult for these stocks to try and reverse this trend. Yes, there could be a pause which could be there in between because of the news flow being attached to the stock prices. But eventually, I think the structure, it plays its part, and the stock prices, they tend to eventually move up higher. From the defense pack also, I think BL is something which I've been recommending. That's a name which one could look at. And specifically, I think trying to take advantage of these corrective phases. If these stocks correct 7% to 10% broadly from their swing highs, and BEL was almost at 460 levels plus a couple of days back. So correcting from those high levels, if these stocks come back towards a good support level, support point, it's a very good zone to try and go for an averaging out.
Okay, all right. Sunil, within the power space, some of these power financiers, I was just looking at the flash at the bottom of the screen, REC, and we have these PE ratios now flashing. REC is at 4 times earnings. That's what I was, really seeing. You believe that starting to look interesting, and this is trailing 12 months, of course, the PE that's reflecting, but starting to look interesting, some of the power financiers?
Yes, I think so. They are starting to look interesting because I think, see, power is a good story overall. And rather than the actual power players, the PSU, the financials are, I would say, a better bet. because with all the data center you mentioned, the other thing which data centers need is a huge amount of power. We know that this whole AI revolution needs power. So I think that to that extent, the demand for power is going to be very, very high, and financing this whole capex creation there is a big story there. So yes, I do believe that the power financiers are beginning to look attractive.
What about charts, Kunal?
See, from the power stocks, NTPC, of course, and Power Grid were the two names which have been doing very well. Tata Power today, for the first time, has managed to come back above the 200 DMA. I think the stock was at 389 or 390. That was the 200 DMA for the stock. I'm not sure whether the stock would be closing above those levels, but even if it's a breach, and maybe a couple of days, if we see that confirmation happening for Tata Power, that could be another stock which could be added to the list.
And sorry, REC, PFC?
So REC, I think, post that news flow from the budget day, that stock has been a huge underperformer. So there was a point where REC was one of the stronger names from the power financiers. PFC was second rung. Now that those tables have turned, you're looking at PFC as a lot more stronger. The stock holding on to 410, 415 mark broadly. REC is sub 400 mark, and that clearly tells you that the underperformance is still there.
Okay, let's begin winding up for the day then. Sunil, we'll let you go on that note. Kunal, good to have you on the show as well as always. Well, we're closing in pretty much around the session lows. That said, one thought that perhaps there's going to be a continuation of yesterday's rebound, but not quite, because we've fallen prey to the global weakness today. I mean, keep a close eye on Europe, on the US futures, and what kind of handover we finally wake up with tomorrow, because almost a 2% decline is what you've seen for the Nifty alone, with the Nifty Bank colliding about 2.25%, and the private banks, they were the ones which really got clobbered because of the high weightage as well, dragged the Nifty lower, 2.5% of a cut coming in on the Nifty Private Bank. Autos, of course, sectorally have been the weakest link today. A 3% downtick is what you've seen on the auto index alone. So between autos and banks, Nifty PSU Bank lower by about 2%. A large chunk of the market was definitely weighing in heavy. FMCG, IT, chemicals, realty, all these sectors as well were under pressure. Just marked or minuscule of resilience from Nifty Pharma and Healthcare. That too because of some of the individual names, which I'll talk about in just a bit. But look at a Bajaj Finance, that's going home with an over 5.5% downtick on its futures. Axis with a 5% decline. Bajaj Finserv down 4%. Eicher Motors down 4%. 3.7% of a cut coming in for M&M as well. JSW Steel down 3.5%. Bajaj Auto down 3.25%. Tata Motors PV down 3%. Maruti down 3%, Bharti as well 2.8% lower, and then of course Trent, Tata Consumer, Asian Paints, Titan, SBI, TCS, BEL, Ultratech Cement, Kotak, they've all followed or rather fallen in excess of 2%. It was an equally weak day even for the Reliance Industries and HDFC Bank, and between those two names, a large weightage of the index of course also drags down. Reliance goes home with a 1.8% cut, and HDFC Bank as well fell by about 1.9% or so. Colgate, a rank underperformer from within the broader market, 7.5% of a cut. KEI was down about 5%. TVS Motors slackened by about almost 5%. And then, of course, even names like a Keynes, for instance, which did have their FDI cheer to them when they started off trade. KEI, not KC International, KEI Industries will just come up on your screens. They go 4.5% lower, and Keynes, etc. as well did finally claw back with the rest of the market.
Yeah. Otherwise, a tough day overall. In terms of the breadth, it worsened significantly as the day went by, and we saw an advance decline, which was 3:1 in favor of the advances at the start of the day. That has sharply turned. 2:3 in favor of the declines is how this has played out. So very, very strong tilt. Even though sectors have moved quite sharply, the Nifty IT has moved lower fairly sharply. It was in the green at the start of the day, has closed 1.25% lower. But with that, completely out of time on this edition of Closing Trades from Aisha, myself, everyone who puts this show together. Thanks so much for watching.
In a